Let me introduce our next speakers. We're very honored today to have two of our own speaking with you. One of the common themes that we get questions asked is, if I'm not an accountant, how do I understand financial statements? What do they mean? And particularly in instances today where we are struggling with cost increases and wage inflation, et cetera. And so in areas where we may need to be assessing the financial health of a contractor, the subcontractors, the suppliers that we use, or the general contractors that we use. And so how do we determine whether or not a contractor is healthy or not healthy, and what does the financial statements mean? And how do you understand that if you weren't an accounting major? And so we have David and Zach with us today. David is a director in the Lynchburg office of Brown Edwards. He has extensive experience in providing assurance, consulting, and taxation services, specializing in the construction and private education industries. He received a BA in accounting from the University of Lynchburg and an MBA concentration from the University of Lynchburg as well. He is a CPA. He is a certified construction industry finance professional and a member of many business organizations. He enjoys traveling, gatherings, and other activities with family, enjoys volunteering his time with several local organizations in the Lynchburg market. And he says at times he likes to imitate working on construction sites through his various home improvement projects where his wife is the superintendent. And he is, if you've ever seen David, you'll know that he's an avid college basketball fan and played college basketball himself due to his height. Also with us today is Zach Weber, who is a director in our Richmond office, who provides auditing, assurance, and business consulting services to construction, real estate, manufacturing, distribution, and not-for-profit clients. He has expertise working with closely held businesses with revenues up to $1 billion and assists with short-term and long-term planning as well as financial statement compliance. He has assisted several clients with mergers and acquisitions, including financial due diligence and purchase price allocation accounting. He has industry expertise in construction, employee benefit plans, and manufacturing. He holds a BS in accounting from JMU and an MBA from VCU. His hobbies and interests includes hanging out with his wife and 3 kids, which includes a little one that came not too long ago, running and weightlifting. So please welcome David and Zach, and look forward to their presentation today.
All right, thank you, Billy, for that, and thanks to the first 2 presenters, Jay and Todd, for their interesting presentations. As Billy mentioned, this presentation is really designed for for people who may not be CPAs or may not be dealing with financial statements every day. We kind of noticed that need and talking with clients and other people in the industry that many times non-accountants are tasked with evaluating either subcontractors or even evaluating and managing their own financial performance. So we think it would be helpful for them to have that knowledge, and to people on this call, you may be, I think we have a lot of CFO or controller types on this call. If you think that any of this information would be particularly valuable, we're happy to share the slides or even come in and speak to anyone in your organization who you think could benefit from this type of presentation and knowledge. So by the end of the presentation today, we're really hoping that you can take something back, either to apply yourself or to apply to others within the organization to ultimately make better business decisions and better understand financial statements. Having some trouble with my, there we go. So I wanted to go over kind of first, the learning objectives for today's presentation. First we're going to discuss, what are the basic financial statements that we're looking at? Why is each one important? What can each one tell us? And what are some key points and metrics to look out for on each one? And how do those metrics apply both to just generally in the industry, benchmarking, and are there any like real red flags that we need to look out for when we're evaluating a set of financial statements? So as Billy mentioned, as you can see, David and I today on the presentation. Before we get too deep into the into the content, just a little bit about our firm. If you're not familiar, I know we have a lot of clients on here, but some people may not be as familiar with the firm and our construction practice, and specifically, we are ranked one of the top 50 construction firms by Construction Executive Magazine. We've got over 400 team members in 3 states. I think also, just 4 days ago, closed on an acquisition of a very reputable firm here in Richmond, where I am, Mitchell Wiggins, which for those of you in the Richmond area may be familiar with, and we're very excited to work with those guys, and they have a very strong construction presence as well, and really looking forward to kicking that off and just continuing to work with more people in the industry and do what we can to educate and help people grow their companies. So, like I said, we wanted to start with, what are the basic financial statements? So, for the CPAs on this call, like this is, accounting 101, but it does, serve as a good basis of understanding for those who may not have that level of knowledge. So, we've got the balance sheet, the income statement or profit and loss statement, the statement of cash flows, and in the supplemental schedules, technically aren't considered part of the basic financial statements, but these are schedules and statements that we like to provide in each one of our contractors' financial statements, because we think it provides very useful information to the users of the statements, which is typically your bonding companies, and then also internally for management's purposes. The schedule of contracts in progress and completed contracts really lets us dive deep into the numbers and how contracts are performing. David's going to talk a little bit about those at the end. And then the schedule of contract revenues and cost of revenues, your schedule of G&A expenses, which lets us really analyze where management is spending overhead costs. And then to me, a really interesting schedule is the ratios and statistics, which allows a user to quickly look at how does a company stack up against others in the industry, best in class contractors, and really helps you to evaluate just where we stand on a number of metrics. So Holly, I'll let you kick off the first polling question here.
Okay, so our first question is, how would you rate your level of construction financial statement understanding? Expert, generally understand, but could use some guidance. And what is a financial statement? Don't think we're getting many of those. That's good. I'm going to give it about 10 more seconds or so to get some more answers in here. We're ticking up to our normal percentage. Okay, I'm going to go ahead and close the poll, and I'll share the results. So looks like most of us on here are 61% are experts, and then 38% generally understand, but we do have 1% that wants to know what a financial statement is. So maybe one of our folks chiming in, being funny, I don't know, but anyway.
Well, that's good to know. Like I said, for the experts on this call, some of this is going to be very basic understanding, but as I mentioned, we would be happy to talk with anyone in your organization that you think could use this type of knowledge. So we'll start with the balance sheet. What is the balance sheet? Why is it important? What does it tell us? The balance sheet gives us information about a company as of a point in time. So it's a specific day. Typically, we'll be looking at a balance sheet as of a year end, but it could be a month end or really any day in time. It tells us the assets of a company, which represent a future economic benefit that will convert to cash eventually. Liabilities, kind of the opposite, future economic detriment or use of cash in the future. These two are split between current and non-current. Current meaning that it will convert to cash within the next 12 months or operating cycle. which could be longer than 12 months for a contractor. And that will become important in some of the ratio concepts that we look at in the evaluation of a balance sheet. And then your equity is just the difference in your assets and your liabilities. It represents funds contributed to the company over time by the owners, plus cumulative earnings of the company, and shows us kind of a book value, not necessarily net worth, but you know, on paper, what is it worth? It may be worth more than that in actual dollars. You know, why is this important? You know, for someone evaluating a subcontractor, maybe it tells us how liquid a company is. So, you know, there's a risk that if you're evaluating a subcontractor to work for you, or even selecting a general contractor to complete a project, you know, you have a risk that that company goes out of business before you get to the end of the contract, which would be not a good situation for you. So this tells us what, you know, is there a strong likelihood of that happening? Are there red flags we need to look out for? Anything that would prevent us from wanting to do business with a company over the long term. So what are some key metrics on the balance sheet that we look at and think are important? So the first one that I like to look at is what's your working capital. So earlier I mentioned current assets, non-current assets, current liabilities, non-current liabilities. So working capital is the difference in your current assets and your current liabilities, which basically is telling us how much cushion is there on the balance sheet for us to be able to meet obligations in the next year. So, you know, we typically want this number to be greater than zero. The larger it is, the better. Just indicates that the company is strong and is hopefully going to be able to meet its obligations, pay its bills. Another thing that I like to look at is whether the company has loaned any money to owners of the business. This isn't necessarily a red flag. It can be a common practice, but it does, you know, make you look a little bit more at the overall context of the numbers. See, you know, hey, are owners taking money out of this business for personal use? So, you know, if you see that a company is really low on cash and they've borrowed a lot, or they've sent a lot of money out and they're owed money from the owners, you know, that could be an indication of a red flag or something just to follow up on, just something to be aware of. The next is costs in excess of revenues and billings in excess of revenues. These are your under and over billings. You know, under billings, while it's an asset, not necessarily a good thing to have on the balance sheet. It's something that when we see, we typically dig in and ask some questions. You know, it could indicate, you know, hopefully it indicates just a timing issue with billings. It could, you know, on the negative side, indicate profit fade or just an overall problem with the ability to estimate future costs, indicating that, you know, we're kind of not fully capturing the remaining cost on a project. Billings in excess is kind of the exact opposite, meaning that we're hopefully being overly conservative. Hopefully there's some profit left towards the end of the job that we can take, or we've been able to bill very aggressively, which, you know, should be the goal. Is, you know, we'd like to use the project owner's cash, or if we can, the GC's cash to fund a project rather than our own. You know, each contract has different rules, obviously, governing the billing, but that's what we want to try to do, especially as we grow. So the next thing I had, it was just kind of a very basic balance sheet to walk through a few of these key metrics. You know, if you look at a contractor balance sheet, it may look something similar to this. There's a lot of times there may be some additional items, but this is very simplified. You've got current assets, property and equipment is the only long-term asset here, and then we've got current liabilities and then some long-term debt, and then equity. But so we'll just walk through a few things. You know, first, like I said, was looking at working capital. So you take your current assets and your current liabilities, take the difference in those two, and come up with working capital for this contractor of $1,200. Which, you know, if I'm looking at this, that seems to be strong. It looks like, you know, they've got a decent amount of cash, receivables. There's nothing that number that would make me really question anything right off the bat. This specific contractor doesn't have any loans to owners, so that's a good thing. It indicates that they're keeping the cash in the business to complete projects, and not withdrawing it for other reasons. The other two items that we talked about was your billings in excess and your costs in excess, revenues in excess. Here we've got a net overbilling, which is a good thing, meaning that on a net basis, we're able to bill in advance and get ahead of the contract's progress on the billing side. And you can see here, so the other thing that I like to look at is when we have an overbilling, do we have cash and receivables to kind of that cover that overbilling? Here we've got $3,500 in cash and receivables, $1,500 in billings in excess, which indicates that likely those billings in excess have either been collected and are held in cash or are still on the balance sheet as they are. We could have a little bit of a problem if we had the opposite case. If billings in excess were larger than those two items, could indicate that possibly certain contracts are being billed, received, and then used to pay bills of another contract, which is could get us in trouble and something that we want to watch out for when we're doing our evaluation. So that's kind of the balance sheet. David will get into more of the metrics at the end in terms of evaluating working capital and the current ratio and some other key metrics in comparison to best-in-class contractors and kind of averages across the board. But that's the basic information on the balance sheet. So next is the income statement. We'll kind of walk through this similarly. What is it? Why is it important? What does it tell us? So the income statement or P&L statement tells us information over a period of time. It tells us, are we making money? Are we making money first from our contracts and contract revenues minus cost of revenues gives us gross profit. We like to see that just from completing a contract, we're net positive on that. The next item is we look at operating or G&A expenses, which kind of tells us where the company is spending its overhead. And hopefully after that, you've got some profit left over in operating income, which kind of tells us, hey, from operating the business, just normal operations, are we making money? And then you've got other income and expenses listed, which are usually one-off type items that aren't central and primary to the business. The business could be run without those items. So you may see things like interest expense or investment income or gains and losses. The big one that everyone saw last year and may see some more this year, depending on your situation, was PPP income. So it's typically things that PPP income isn't expected to recur. It's not really part of running the business. So you want to evaluate those type of things for items that have an outsized impact on net income. So if total net income is driven primarily by something in other income, it may raise some questions. You want to see positive operating income. Why is this statement important? Well, like I said, it tells us, are we making money? You don't want to, you may not want to engage with the contractor to work for you if they're not making money on their work. Obviously you don't want to be overpaying for a contract, but at the same time, you need your contractors to make money such that they can continue to pay their bills and continue working and get your project done. So this is a very important statement, just to make sure that a company is well run and understands its cost structures and understands how to bid jobs in order to sustain into the future. The key metrics, kind of like we talked about, gross profit margin on contracts. How much on a percentage basis are we making just from completing a project? Next, operating expenses is a percentage of revenue. Are we able to control overhead costs in such a way that we can maintain overall profit? And I talked a little bit about other income. Really there, we're just looking out for anything extraordinary that may not be recurring or that may unproportionately drive either income or loss, that we may want to back out to normalize the activity of the company. So again, very basic example. You may see something like this either on your own financials or evaluating a subcontractor. So this is a 20% gross profit company, which is depending on the type of construction you're doing, whether you're a GC or a sub, could be a good number. I've seen GCs as low as 6-7% at times, maybe a little bit lower. Some of your specialty trade contractors maybe 25-30% on gross profit or higher. So just you got to understand kind of what you're evaluating. But this company in general looks pretty healthy. Operating expenses are 15% of contract revenues, and they've got a healthy 5% operating income line. And then in this company, there's no significant other income or expense items. You see interest expense, which is common for a company with debt like this one did on the balance sheet. So looking at this overall, we've got operating expenses, operating income, and then overall net income. 5% is a pretty healthy bottom line number. If you were evaluating a contractor to work with, you would say, hey, this company looks like they have a good understanding of their numbers and their structure, and hopefully will be able to sustain themselves. So next is the statement of cash flows. This is a statement that a lot of times gets overlooked a little bit. It doesn't get as much scrutiny, but I actually think it's a pretty valuable statement when evaluating a company. It tells us where cash is going, and so it breaks cash flow into 3 categories: operations, which is what are we doing with cash as it relates to our primary business, doing contracts, completing projects. Are we gaining cash or losing cash from that? And then it also breaks down other activities, investing or financing activities. So are owners putting in money to keep the company afloat? Are we getting tons of bank debt to keep the company afloat? Are we having to sell investments or sell PP&E to make the company continue? Or are we able to take cash from operations and invest it back in the business with buying new equipment, buying long-term investments, paying loans, paying distributions to owners? Those are the types of things that indicate a healthy business. Like I said, the key metric here is, are we generating cash from operations? That's the number one thing. And then what are we doing with that operational cash? So quick, down and dirty example here of taking the same numbers that we had on the other statements. So this company had 460 as net income. The key thing to remember is profit on the P&L statement doesn't necessarily equal cash flow. So you could have a profitable business on paper that could be losing cash from operations based on their working capital management and some other items, to what's generating income. So in this example, we've got a difference. We're actually generating more cash flow from operations than net income, which is a positive thing and makes the company look healthy. That's mostly as a result of depreciation, which is a non-cash item. But then the other thing is working capital management. So we talked about working capital a little bit on the balance sheet. The key concept there is that, in general, we want to try to collect on our receivables as fast as we can and delay our payables as long as we can. It helps with the cash flow operating cycle. And, we don't always have control over that, but we do want to try to time those cash receipts from contracts with the payments to vendors related to those contracts. And this company was able to do that successfully and generated, $600,000 of operating cash flows, which you're looking at this like that's very, very successful. And then they put $300,000 back into purchases of property and equipment, which tells us that they're reinvesting cash into the business. The owners aren't taking it out. This seems like a contractor that's around for the long term, wants to grow, wants to invest, and someone that you probably would feel good about continuing to work with. And then the last thing here is kind of the other key point is you look on the balance sheet, right? Cash increased in total by 250,000, which is great. But the thing to remember is, just from running the business, it was actually up more than that. So that's why I like to look at that operating cash flow number, because it kind of strips down all of the other aspects and looks at just at, hey, from doing our primary business, what does cash look like? So those are my kind of main points. I think next we've got a polling question that I'll let Holly take.
Okay, so our next question is, do you regularly review and interpret contract schedules? Yes or no? Okay, I'm gonna give it a few more seconds and then I'll close down the poll. Okay, so we have 69% that says yes, and then 31% that says no.
All right. I'm going to turn it over to David. He's going to get more into those contract schedules and the supplemental schedules that I discussed at the beginning.
Great, thanks, Zach, and thanks, Holly, for the results there. I'll try to teeter on the 69%, 31% line of how to address this. But that being said, as we mentioned before, the supplemental schedules, those aren't required by GAAP. A lot of times, though, external parties, especially your bonding agent, will request them. You can see below the ones we mentioned before that are our suggested supplemental schedules. Obviously, those can be tweaked. One thing to note, though, for Brown Edwards clients, a lot of times we will issue a short form and a long form statement. And the short form really for folks that don't need the job information, bank perhaps, and then the long form for your bonding agent or for managerial use as well. I guess where I'm headed with that is, one, if you get a short form on a sub and you need the long form, don't hesitate to ask. Two, maybe that's something you can look into if you're not getting that service currently. Down at the bottom, you can see provide management with information for decisions. Bonding companies will evaluate your jobs and benchmarking. So we'll flip on into the first schedule here. See if...
Hey, David, I'm gonna share a comment because it doesn't go out to the whole group.
Sure.
That Susan made, that many of her clients fail to look at the balance sheet, thinking it's not important. But if the balance sheet isn't correct, then the income statement upon which they rely is also not correct. So I thought that was, a good point to make back on Zach's part of the presentation.
Mm-hmm.
Thank you, Susan.
Let's see here. There we go, Zach. So the first thing, this is the standard Brown Edwards format. A lot of times, different firms or different companies will present their job schedules slightly differently. But the big thing when you get one of these is really to see how it's laid out. On the schedule of contracts in progress, we really call this, in a lot of ways, it's the big estimate or big estimates that lead up to one big estimate that impacts the balance sheet. But as you can see here, our presentation on the left side, you have the total contract. So that's for each job, the total revenues expected, and then the total estimated gross profit, hopefully not gross loss, but sometimes those do bubble up. The middle of the job schedule, you'll have the job activity to date. A lot of times, for contractors, the jobs will complete within a year. Sometimes, your heavy highway, large civil projects, those will stretch multiple years. So the middle part takes from the beginning of the job to the cutoff period of the financial report. And then the right side is going to be the activity for the current year. And one thing I meant to mention to begin with, when you peel into these supplemental schedules, ideally, and from the statements standpoint, the contracts in progress, current year activity, plus the completed contract, current year activity should tie and reconcile back up to your income statement. And ideally, that would also reconcile and tie back right to your general ledger as far as what your job costs are and your job revenue. Key items to look for when you're going through one of these, on the total contract, a lot of times the estimated gross profit, take that into a percentage and see if there's any outliers. And maybe you want to gather an understanding of why one's expected to be so much more profitable or not as profitable as other jobs. If you're looking for a sub that's doing comparable work, look at jobs that may be comparable size or comparable in nature and see how they perform. In the middle part, I did forget, I overlooked the contract revenues earned in excess of billings, or short form under billings, and your over billings. That's at the cutoff. And a lot of times you want to look for large under billings and get an understanding of why that is, because yeah, as Zach mentioned, contract terms can stipulate how billing works. And other times, especially if it's a statement, that maybe hasn't been audited or reviewed, maybe it's a job that's headed south, but it just hasn't been recognized yet. So that's something to keep an eye out for. The other item that we look out for a lot of time, some people would call overbillings in general just job borrow, which is okay. That's what you want, the cash flow on the front end instead of financing it yourself. What you really need to keep an eye out for is pure job borrow. Pure job borrows when your bill to date is in excess of the cost to date plus the total estimated profit on the job. Maybe if there's a lot of pure job borrow going on, it could allude to some other potential issues underlying the statements as a whole. If you do have large job.
David, would you repeat that calculation once again, please?
Sure. If you take the bill to date and compare it to the cost of revenues to date, plus the total estimated gross profit on the job, if the bill to date is bigger, that is considered a pure job borrow.
Thank you.
Mm-hmm. On larger jobs that are crossing multiple periods, one thing you can do on this schedule is you take the from inception to the cutoff and back off the year-end amounts or the activity in the current year to compare that gross profit originally to the gross profit that's showing in the current year. That'll give you a feel on whether that project is gaining or fading for that company. And maybe that alludes, if they have a lot of contract fade, maybe there's a little bit more risk involved there. Or if they have contract gain, maybe they're being conservative on the front end, which may give you a little better feeling about them. And another thing, a lot of times on a variety of these schedules, does the math work? That's another thing to check, just the general math, does it make sense? If it's an audited or reviewed statement you're looking at, hopefully it does, but if it's an internal management statement, it's worth double checking. And with that, we'll flip on over to the completed contracts. A lot of times, a comparative statement would be issued. So there'd be 2 years of contracts in progress, 2 years of completed contracts, and you can do the gain fade analysis a little bit easier when there's 2 years. For the purpose of this, I was just kind of looking at it on a single year basis. So on the completed contract schedule, it's laid out similar to the contracts in progress a lot of times, but slightly different, where the left side, once again, is the contract totals. However, the middle column, instead of contract to date, it is the amount that it was incurred before the current accounting period. So before January 1 in this example, and then all the way to the right is the year-end activity. So once again, similar to the contracts in progress, you can compare the gain fade, where you would look at the gross profit percentage being incurred before the current year and then what was incurred in the current year, and compare them to see whether those projects were gaining or fading. And once again, when you're looking at it, if you're assessing it, look at how similar sized jobs are finishing out. A lot of times, you know, contractors, sometimes the bread and butter is the smaller jobs and they struggle with the bigger jobs. Well, does that make sense for what you're looking to utilize them for? And then another thing you can see on the gain fade, just to give you a little flavor for that, on that building one job down below, you can see the gross profit of $250,000. That was originally 5% gross profit, but when we look at how it finished out of $1 million on $9 million contract, it actually increased to 11% gross profit. So that gained, where building number 2, you can see the fade there. We, in the prior year, thought 200,000 on 900,000 earned, excuse me, or 22% gross profit, but we ended up with a big swing to a 25% gross profit loss. And not only, I've said a lot on when you're comparing and considering other folks, but internally, you know, a best-in-class contractor will sit down and will really review and critique these job schedules. And one of the things that we've seen to be really productive is on the back end, let's say the job's done and finished, is to have job reviews. And it's one thing to have a job review and you kind of pull a party in one at a time, and you know, maybe the PM blames the supervisor. Sorry, I had a little back there. The PM, you know, could be point the finger supervisor points the finger elsewhere, estimating points of finger. You kind of get in a who did what type scenario. So what we see to be most productive is when you bring all the key players together in the room together, and minimizes the finger pointing and can really get down to what actually happened on the job, on whether it was good or whether it was bad. And that gives you great historic information moving forward when you propose on similar jobs in the future. As far as the day-to-day, you need to be evaluating these job schedules, because really, if you have a job that starts to go south, identifying that before the job is 20% complete is key to having some recovery in the job. You know, as you start, it's kind of like a snowball going downhill. The further you get, the bigger the snowball is. You can't really dig yourself out once it's, you know, 60, 70, 80, 90% complete. So something to keep in mind on really evaluating it on the front end. And you still need to manage it as it goes along. But then also, when the dust settles, there's a lot of valuable information that can be gleaned from these for future jobs. That being said, we'll flip on to the next one. As Zach mentioned, with the contract revenues and cost of revenues, oh, sorry, we got a little spacing issue there on the contract revenues, but on this schedule, it really just breaks out where those costs are going. And obviously, based on the nature of the contractor you are, it's going to be different. GC is probably going to have a lot more sub expense. Heavy highway civil is going to have a lot more equipment per se. Specialty, maybe more labor than others. So it's there. It provides some information. I would say it's more intuitive or useful over a trend period, more so than a single year. Internally, that is. All right, I want to flip forward, Zach. Thank you. General administrative expenses, kind of similar thing here, that it's really just breaking out the overhead expenses. When I'm looking at it, you know, you want to see it's reasonable. Red flag, if I was evaluating a company, if they had high professional fees or high legal fees, you want to make sure there's not something going on. It's worth the inquiry. If you see a really high professional and legal, you know, maybe there's a claim against them that's being litigated, or hopefully not their CPA charging too many fees, but maybe that's the case, and maybe that gives you a little comfort. But not much here from a day-to-day. Obviously, management wants to look at it, and over a trend period is probably a little bit more useful as well. So we're gonna flip forward, Zach, and get into the ratio analysis. So the ratio analysis that we provide in the back, that is ratios that we've found to be important ratios for a contractor, some of them more important than others, and they've kind of been broken down. And normally what we'll do in a comparative statement is show 2 years. These can all be calculated from the information presented in the financial statement. So if you're looking at a statement and it's not available, you can calculate these ratios. Another thing we tend to do is benchmark these ratios against the CFMA for the type of contractor you are. Now, CFMA populates these annually. There's sometimes some lag time on the ratios, but it does give you something to compare to. And that's a national poll. So looking at the top here in the liquidity ratios, first off, the current ratio, it's a liquidity ratio that measures the company's ability to pay short-term obligations. The bare minimum here is that you would like to see is a 1. Obviously, you would like more current assets than your current liabilities. Higher is better in this ratio. Next would be the days of cash. And what this is trying to measure is if the revenue stop coming in, how many days of cash would you have to cover the daily revenue? General recommendation is to have at least 7. And I meant to mention on the front end, the recommendations aren't on this slide right here, but in 2 slides down have all the recommendations. So don't feel like you got to scratch them all down as we go. They are within the slides. Next being working capital turns. That's the amount of revenue being supported by each dollar of net working capital employed, or in other words, how efficiently is a company using its working capital to support revenue? Generally want that over 30, or excuse me, if it's over 30, it may mean there's increased working capital needed to support growth. And as probably most of us know, one of the most dangerous things for a contractor is to grow too quickly. So some of these metrics are trying to evaluate that. The next one being working capital, and that's your current assets minus your current liabilities. And Zach touched on that. Basically, it's the financial capacity to perform your current backlog. A very generic approach, with bonding, and maybe it's something you want to look at. Obviously, each bonding company has its own adjustments and underlying algorithm, but a generic approach is taking your working capital times 10 for an aggregate bond level. And your largest acceptable job would maybe only be 1.5 to 2 times your current largest job. Those are kind of guardrails and something to consider. Obviously, if you're looking at a sub and they've only done their largest job's a $500,000 job and you're looking to sub out $8 million of work, there's probably a decent chunk of risk involved on whether that sub's going to be able to perform it. So that's the key thing to consider when you're looking at subs. Next, diving down into the profitability ratios, the first one being the return on equity. Basically, this is the profit generated by the equity employed. If you have a high ratio, it can mean there's undercapitalized. A low ratio could mean it's a very profitable company. Lower is generally better in this case. Next, there's a series of gross profit calculations over all contracts in progress, and your completed contracts. Obviously, a higher gross profit percentage is preferred, but when you peel it back and you look at just the construction in progress and the completed contracts, ideally you would want to see a lower gross profit percentage on the contracts in progress and a higher a gross profit that is higher than the contracts in progress on the completed contracts. That would allude that their estimating and management is conservative in nature. Obviously, if they're going the other way, they're telling you they're going to make a bunch of money, but then it slides. That can be a pretty dangerous endeavor. That what if they have one that really slips up before in the middle of your job, and maybe there's issues. Below that is the general and administrative expenses as a percentage of revenues. Basically, this is how much overhead is being used to support the generation of revenue. It's important controlling controlling G&A is very important at times that you see spikes or decreases in your revenue or your production, and it's something to really keep an eye on. Generally, I believe the example here was 15%. Generally, we see it in the 10 and 15%. But once again, that fluctuates based on the type of contractor and the type of contracts. But generally, 10 to 15% is the average. Next below that, times interest earned. You know, a lot of times the majority of contractors, cash is king, not as much debt, but obviously heavy equipment or folks that have debt involved. This measures the ability to meet interest owed on debt from operations. A low ratio could indicate over leverage. A higher is better in general. And below that is the return on total assets. How well is the company generating profit from the assets employed? Higher is better. And we're peeling down, let me see here, on the activity. Thank you, Zach. On activity, taking your depreciation expense as a percentage of fixed assets. This is really trying to measure your aging fixed assets. So it's comparing the expense you're incurring to your net PPE. A higher ratio could indicate aging equipment. And then below that is the contract cost as a percentage of revenue. Once again, kind of similar to the on that contract cost schedule where it broke it all out. It basically takes each one of those line items and compares them as a percentage of revenue. And once again, this is going to vary by the type of contractor you are. So there's no crystal ball on what's recommended at a high level. Next, debt to equity. How much debt is the business carrying compared to the amount invested by the owners? Usually you want to see that at 3 or less. Revenue to equity, amount of revenue generated for each dollar of equity invested, 15 or less on that metric. And net fixed assets to net worth. How much of the owner's equity is invested in PPE? You know, if it's a high ratio, there could be a lack of funds for current operations, or a low ratio could indicate favorable liquidity. I was putting it together, thinking about it a little bit further. You know, it's kind of a backdoor way that if you can't get the working capital, in some ways, you could assess how much liquidity they could have based on the PP&E compared to the equity. With underbillings to equity, once again, underbilling is kind of a red flag. How much current work is being financed by the owners or by the company? You know, if your underbillings are high, that you're financing the job for your customer. Now, there could be stipulations in the contract that that's how it's going to be, but it also could be a red flag that there's other issues. Normally want to see less than 30% on this ratio. Backlog to equity. How productive is your backlog at generating a return? Is there enough equity to back the current backlog? And once again, this is one of those metrics that is trying to make sure the growth isn't too quick. In some ways, if that's pure equity without draws out of it, 20 or less is usually acceptable on that. And we'll dive into the last part here, the asset efficiency. Backlog to working capital. Is there enough capital to fund the backlog? A high number could mean more capital is needed. Once again, similar to before, higher could be a flag that there's more capital needed to get the job done. Months in backlog. You're taking your backlog over revenue divided by 12. This measures, you know, if there was no other work obtained, how many months would it take to complete the current backlog? Once again, it varies by type of contractor, but generally higher is better. We want a cushion of work to get done and keep in our pipeline. And lastly, days revenue in AR and days cost in AP. With AR, it's how long does it take to collect your AR? Lower means faster collection, higher number means slower collection. You really want to compare this to AP. Are you taking cash in quicker than you're paying it out? And sometimes that's hard to do with, especially job costs, when you compare it to the credit terms of a vendor. You know, materials probably are due a little bit sooner than paying down on a progress billing from a sub. And that there's a lot of ratios here, and you know, you can slice and dice it a bunch of different ways and see how it would impact it. But at the end of the day, when we're talking at a high level, you know, cash is always king, and working capital is super important. One item that the ratios don't really take into account, but it's something to consider when you're evaluating your own company or maybe you're evaluating subs is, you know, is there line of credit accessibility or capacity? Obviously, if the company's tapped out on their line of credit, there's probably some other issues going on there. But you know, if there's some risk involved and you know, you're worried about the company's liquidity, well, do they have access to other liquidity? And that capacity is something to consider. With that, we'll flip on forward, Zach. I think we're to the on a poll. I believe we got a poll question here, Holly.
Okay, launched a polling question, which is not a component of working capital. Accounts receivable, billings in excess of revenue, and sorry.
I was just saying, I think one of the answers, there should have been a fourth one. I think it got cut off, and
oh, okay.
So the fourth one may or may not have been the correct one.
Hopefully the fourth one was not it. Trick question.
Let's take the second best guess based on maybe what a company would adjust for. How about that?
Okay, I'm going to give it a few more seconds to get a few more in here. Okay, I'm going to close this.
All right, great.
So billings in excess of revenue took the lead at 49, and then prepaid expenses were 45, and then 6 accounts receivable, and then the unknown answer. You can share that with us.
So yeah, property and equipment was the fourth one before. Would have been the most accurate answer, I believe. All right. So here's our key takeaways. Discuss the basic financial statements for a contractor, why they matter. Items to look at when evaluating the contractor's financial health. And job schedules and how they compare and key items from that. And the other underlying schedules and ratios and statistics and benchmarking. Were there any questions at this point?
We do not have any questions. Tim just added a comment. In your defense, the bonding agent will give credit for prepaid expenses in their working capital.
Yeah.
But nope. Let's see. I do have Teresa with a raised hand. I'm going to open up. Teresa, I'm going to open up your mic. I think you may be self-muted now if you want to make a comment or ask a question.
I think that was an accident.
Oh, okay.
Sorry about that.
No problem. I am looking for any other. I don't think so, David. I don't think we have any other questions.
As Zach mentioned, we're always available. Our email addresses are down there. our phone numbers are on the website as well. Don't hesitate to call. We're more than glad to answer any questions afterwards, or if anybody thinks it's valuable or has a group of folks internally that they would maybe want us to present to or share information with, we're more than glad to.
Yeah, I really encourage the folks on this call. This will be recorded and sent out. This will be a good session to share with your project managers, your estimators, people who are assessing key financial health and reading financial statements. Have more and more clients who are talking about pre-qualifying subcontractors. In periods of serious inflation, this is where contractors really are in a lot of risk. We're on predictability and long-term prices, and that's not exactly where we're at in the current environment. And so I would encourage you maybe to share that with the project managers so they have some basics of understanding financial statements. So David and Zach, great job. We're very, very glad and appreciate you doing it.